Can you hit on at least one of the things you and I talked about, where you're talking about the regulation relative to the quantitative tightening dynamic? Like, use the acronyms, obviously, but try to explain it so that we can all understand it.
Yeah, we were talking a little bit about, just the sort of, I guess, the real world implications at the consumer level for what's happening at the long end of the curve being exacerbated by these widening spreads between Treasury yields and agency MBS. So for those maybe less familiar, the basic idea is that the mortgage market, most of the mortgage market in the US is dominated by two companies, Fannie Mae and Freddie Mac. These are government-sponsored enterprises that are basically still under conservatorship from the Treasury, but they back the majority of mortgages in the United States. What they do is they basically provide a credit guarantee against those loans to investors who purchase securities, mortgage-backed securities that are issued by these agencies. They're called agency MBS, mortgage-backed securities. And there's a spread between those securities and risk-free government bonds, treasuries. And at different points in time, that spread can widen or narrow. And ultimately, what's happening in the treasury market is very important to what's happening in the mortgage market. But the mortgage market can take on a bit of a life of its own. And that's sort of what we've been seeing. So obviously, we've got the 10-year treasury yield up at 5%, but we've got the spread between that and agency MBS widening out even relative to that rise at the long end of the curve. And so that obviously is putting tremendous upward pressure on the mortgage rate that consumers see when they go to take out a loan.
This is major blow up factor, right? I mean, you're sitting there, you could be easily looking at a 10% mortgage, right? I mean, without having a monster move in treasury yields from here is essentially the summary of that, is it not?
Yeah, I don't know if I'd go quite that far, but I think the point, 10%, but I think the point is that, I think there's sort of an expectation or an embedded expectation on the part both of consumers and investors that at some point we're going to get back to this sort of zero, this ZERP environment, this very low rate environment, and mortgages will go back down to, whatever, 3%. And I think just structurally, if you understand this framework, that obviously is going to create a different environment prospectively than the one that we've been in. So I think understanding the mechanics of that are important. And yeah, as rates keep rising, not only will that be reflected in mortgage rates, but also this widening spread will keep pushing them higher on top of what's happening in the treasury market. So you get the double whammy for sure.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.